Markets keep whispering the same phrase again and again. 2007. But when we slow down and strip away the drama, what we are really observing is not history repeating. What we are observing is the early sequencing behavior of a credit cycle beginning to turn. The Blue Owl redemption restriction triggered the latest wave of comparisons. A private credit fund permanently restricted withdrawals and began selling assets to return capital. But the headline itself is not the most important part of the story. What matters is the mechanism behind it. Private credit funds often promise periodic liquidity while holding loans that are inherently illiquid. During expansion phases, this structure works smoothly because inflows exceed withdrawals. But when investor confidence begins to shift, the structure reveals a mismatch. Investors believe they own something liquid, while the underlying assets are not easily sold without losses. That mismatch between perceived liquidity and actual liquidity is one of the classic mechanisms that appears when credit expansions begin to reverse. Inside our strategy framework, this type of development sits in the credit stress pillar of the crash cascade dashboard. Credit is the transmission channel that turns a slow deterioration into forced selling. When lenders and investors begin prioritizing cash over yield, the system gradually shifts from expansion behavior toward contraction behavior. What we are seeing now resembles what the original video described as Stage 1 transitioning towards Stage 2. The terminology may differ, but the sequence aligns closely with the credit cycle patterns we monitor. Stage 1 is when cracks appear, but markets dismiss them as isolated. Stage 2 begins when liquidity restrictions or asset sales appear for the first time. Blue Owl, closing redemptions and selling assets, represents that transition. Once a single fund gates investors, the signal spreads beyond the specific firm involved. Other investors begin asking a simple question. If liquidity disappeared there, could it disappear somewhere else? This is how early run dynamics develop in shadow banking systems. Not a traditional bank run with depositors lining up outside branches, but a run on liquidity inside funds that depend on confidence to maintain stability. We are already seeing early spillover signals. Publicly traded private credit managers have seen their share prices fall. Closed-end funds tied to collateralized loan obligations have reduced their distributions. Leveraged loan markets are weakening despite being marketed for years as low-correlation credit assets. When assets that are supposed to move independently suddenly begin moving together, the system is revealing a change in investor behavior. Investors are not carefully rotating, they are reducing exposure across multiple credit channels at the same time. That shift in correlations is often one of the earliest signals that credit conditions are tightening. At the same time, the Treasury market is showing early bull steepening behavior. Short-term rate expectations are drifting lower, while longer-term yields remain more stable. In simple terms, the bond market is beginning to prepare for softer growth before policymakers openly acknowledge it. Within our strategy framework, this fits inside the yield dynamics pillar. Long-term yields reflect both expected policy rates and the term premium investors demand to hold duration. When growth expectations weaken, yields tend to fall, but if deficits and supply pressures remain elevated, long yields can stay stubbornly high. That dynamic creates the rollover trap we monitor in duration markets. The key idea here is sequencing. Credit cracks tend to appear first, liquidity preferences shift second, asset correlations increase third, policy responses arrive much later. So far, the scale remains limited. What we are seeing today resembles something closer to early 2007, when the first mortgage fund losses began surfacing, rather than the systemic break that came later that year. Inside our phase framework, the environment still fits late phase 1 behavior. Markets can remain resilient for longer than many expect, even while credit conditions deteriorate beneath the surface. Our probability calibration reflects that distinction. There is roughly a 60% probability that markets remain in late Phase 1 behavior through the next several months, meaning instability builds, but a full liquidity cascade does not immediately emerge. There is about a 30% probability that credit stress broadens into Phase 2 dynamics by late 2026, as labor deterioration, refinancing pressure, and private credit defaults begin aligning. And there remains a smaller probability that liquidity stabilizes and the system resets without entering a deeper cascade. If you find this type of signal-based analysis useful, consider subscribing. The goal here is to break down complex macro mechanics into clear frameworks, so you can better understand how credit cycles, liquidity shifts, and policy responses actually unfold over time. Now, it is also important to emphasize that this discussion is purely educational and analytical in nature. It is not financial advice, investment guidance, or a recommendation to buy or sell any asset. From here, the focus shifts to confirmation signals. If credit spreads widen further, if additional private credit funds restrict liquidity, and if correlations across leveraged loans and structured credit continue rising, the probability of Phase 2 behavior increases. On the other hand, if credit spreads stabilize, if fund redemptions normalize, and if demand returns to leveraged loan markets, then this episode may remain contained. Credit cycles rarely announce themselves with a single dramatic moment. They unfold through a sequence of small events that gradually change investor behavior. And right now, the system is showing the early signals of that sequence beginning to unfold.